Thank you for joining me today. My name is Jason Ritzenthaler, and I'm Chief Investment Officer at Members Trust Company. I'm really excited to start you on your investment journey here with MTC today. Before we get started, I thought I would just share a little background of Members Trust Company and our partnership with BECU Trust Services. So MTC, Members Trust Company, is owned by over 40 credit unions across the country, including BECU and BECU Trust Services. So our mission is to provide wealth management, trust and estate planning services to credit union members with the same values and ideals as the credit union movement. Today, we manage about $4.4 billion in assets for credit unions and their members across the country. Our services include trust administration, estate planning, investment management, real estate and specialty asset management, retirement planning, and also charitable planning. And so we really strive to provide a personalized service with all the experience and expertise that you would expect, but as I mentioned, with the credit union values and ideals. So with that, I'm really excited to get into the details of our investment process and what we call our guiding principles, what guides us through to the investment strategy and philosophy that we have. There are three main categories when it comes to these guiding principles, and the intersection of these three is really what makes an extraordinary member experience and makes working with MTC simple and valuable to our partners. The three categories are: first, setting our investment philosophy and portfolio strategy; secondly, maintaining investment efficiency; and third is addressing behavioral finance. We're going to go into more details in each of these, but it really is the intersection of these three areas that we think is kind of the secret sauce to MCC's investment process. So first, setting investment philosophy and portfolio strategy. What we'll do is we'll go through what we believe in each of these, how we behave, and then the outcomes that we achieve. So when it comes to setting investment philosophy and portfolio strategy, what we believe is asset allocation, which is just a fancy way of saying the mix between stocks and bonds in any investment strategy, is the most important factor in determining a portfolio's level of risk and eventually return over time. There have been many studies over time, and just about every investment firm and strategy believes in this premise, that asset allocation, just that mix between stocks and bonds, is the biggest factor. The problem is not many firms actually focus on that. A lot of firms believe in this, but then focus more on how do we manage individual stocks, what individual bonds. We really believe in this and focus on it as one of the primary things that we believe. The second is positive outcomes are best achieved through the development of a long-term strategic asset allocation, which is actively managed for risk. So you got to have a long-term plan, and short-term changes to that plan are primarily used to manage risk. And risk is on both sides, on the downside, but also on the upside. And so that's really what we focus on. And the third, this is going to be consistent across all of our guiding principles, but our members' best interest is at the heart of everything we do. Every decision we make, is this in the best interest of the members that we're serving? That's very different from some other investment firms that have different motives. I won't talk about what the motives are, but just know that every decision that we make is this pushing our members forward through their investment process, and are they going to have better outcomes as a result of it? So let's go through how we behave, how we address each of those. So the first is setting a long-term strategic asset allocation, having a plan. We call this plan the investment policy statement. And for each individual that we work with or each trust that we're trustee of, we look at a set of criteria in order to determine what we recommend or how we are going to manage this asset allocation. And you'll notice on the far right, this IPS sets targets for both the equity exposure and the bond or fixed income exposure, but there's some flexibility, plus or minus 10% on either side of that. And we primarily use that flexibility to manage risk within the portfolio. So how do we make this recommendation, or how do we develop the investment policy statement? There are two primary criteria that we look at. The first is your financial ability to take risks, whether it's an individual or if it's a trust, what's the purpose of the trust? And so basically what you look at is what are the needs, what maybe distributions are going to need to come out of the account to cover, necessities, living expenses, how to take care of the beneficiary of the trust if it's a trust situation. So this financial ability to take risk really determines how much risk you can take. So let's say it's an individual account and they need to distribute 10% of the account per year to meet their standard of living. Well, that's a high percentage. And so because that's a high percentage, you need to take probably less or average risk in the portfolio because they can't withstand big swings, big ups and downs. If it's a down market and you're forced to liquidate 10% of the portfolio to make distributions, you might be forced to do that in an opportune time. So if it's a higher percentage of needs based on the total portfolio value, you need to take less risk. Let's say it's a 70-year-old, and oftentimes we'll hear, well, I'm an older individual, so I need to take less risk. Well, if this individual isn't investing these funds for themselves, and maybe it's a trust for their grandchildren down the road, or they're really investing for charities that they're going to support, then they can take more risk. They don't have needs, immediate needs out of the portfolio, so their financial ability to take risk is higher. And this is one of the biggest things that we talk to individuals. They always think age is their most important factor when it comes to what investment mix that they should choose. And age is a factor, but it's not the most important. The second kind of component after you determine the financial ability to take risk is emotional risk tolerance. We call this the sleep factor. How comfortable are you as an individual with the value of your account moving up and down? The more aggressive you are, the more it moves up and down, the wider the range of outcomes. And so why this is so important, and we'll touch on this when we get to behavioral finance, but the easiest way for individuals to have a poor outcome when it comes to their investment strategy is to fall into the fear and greed cycle of emotional investing. We want to make sure we address that up front. And so when markets are down, members aren't going to be happy that they're down, but we want them to be comfortable with the declines that they're seeing relative to the risk that they're taking. And that allows them to a higher probability of maintaining that long-term investment strategy and seeing the benefits of the long-term investments and when the market recovers, similar to what we're seeing now in 2023 after a pretty tough year in 2022 in both the equity and fixed income markets. This IPS also can set some criteria where we can kind of customize the portfolio for individuals. So let's say BECU, there are some ex-Boeing employees and they have Boeing stock, or just individuals have Boeing stock or Amazon stock, and they want to hold it and develop an investment strategy around that. We can do that within the investment policy statement. Also, how we behave is we believe in fewer, smarter decisions. There are lots of investment strategies and philosophies out there that are more like day traders. They're constantly buying and selling and making changes. That adds tax implications, it has transaction cost implications, but also we just believe in focusing on what matters the most. And what matters most is the asset classes that you own, the mix between stocks and bonds. Within equity, it's looking at what's the mix between US and international. On the US side, are we focus more on large companies, mid-sized companies, small companies? Do we have a value tilt or a growth tilt in the portfolio? On the international side, is it developed markets, so Europe and Japan, or emerging markets? What percentages do you own in all those? Those are the decisions that matter the most, not what individual stocks make up those asset classes. And so that's what we focus on, and we'll get into that as we talk about ETFs and the benefits of exchange-traded funds. On the fixed income side, it's really looking at a different set of criteria in how you're managing risk and managing portfolios. One is the duration. Do you own more short-term bonds versus long-term bonds? Years like last year, focusing on more short-term, minimize price declines. As interest rates go up, bond prices go down. The shorter the duration or the maturity of the bonds, the less impact that interest rate changes has. But also the credit quality matters. Do you own more treasury bonds versus corporate bonds or agency bonds or mortgage-backed securities? Lots of different types of fixed income, and they all react differently, and they're taking on different levels of risk. And so within equity and fixed income, those are the primary factors that we're focusing on as we manage portfolios. We also believe in keeping it simple. There are many investment strategies out there that are very complex, and in having a complex investment strategy, please don't mistake that for sophistication. You don't have to have 100 different individual stocks and bonds in a portfolio for that portfolio and that strategy to be very sophisticated and it to have repeatable and consistent results over time. We want our investors to understand what's happening within their portfolio and to be able to really easily and quickly show them why we own different asset classes and how they're reacting. And so what we're seeing now is just one of our investment strategies. It's called a conservative portfolio. It has a 40% equity target, 60% in fixed income, so more on the conservative side, as the name suggests. And you can see in the portfolio allocation section here, these are the securities and the funds that we use within this portfolio mix. So generally, there's 12 to 14 different securities that we include in the portfolio, but within those 12 or 14 securities, we own thousands of individual stocks and bonds, and it's a globally diversified fiduciary quality portfolio. But when we're working with members and investors, we can walk through these different holdings and tell them why we own them and how they're reacting, versus looking at a portfolio of 100 individual stocks and bonds, and we see this from other firms as accounts transfer in. It's very difficult to have that conversation around what's happening in the portfolio, and in all honesty, it's very difficult for the people managing that investment strategy to be able to keep track of it and analyze it as well. So keep it simple. Please don't mistake complexity for sophistication. We have an extremely sophisticated investment strategy that is repeatable and consistent results over time, and we can do it through a simple format that our investors can understand. We also believe in smart but humble. So having this long-term strategic plan is the right thing to do for individuals over time. What's also right, though, is making tactical decisions in the short run, really with a focus of managing risk. And it's managing risk among uncertainty that's out there. We would all love to think that we have this perfect crystal ball and we know exactly what's going to happen 3 weeks from now, 3 months from now, 6 months from now. The reality is nobody has that perfect crystal ball. And the moment that you think you know exactly what's going to happen, the market has a way of doing the opposite. And so you need to be able to stay humble, understand that you don't have all the answers, and just look at risk. What are the risks that are building up in the market? If something changes, how can we manage that risk? And so that's the focus that we have. And oftentimes for individuals, I'll just put this in baseball terms. When a baseball team has lots of home run hitters, they can score runs really quickly when they're swinging for the fences. The problem is that they also strike out a lot. And what comes to investing, the best way to achieve long-term positive outcomes and returns is to minimize the strikeouts, minimize the downturns when they come. There are always going to be ups and downs, but if you can lose less in those times, then in the long run, you're going to make more, and ultimately that's where we all want to go. And so we're trying to be more consistent singles and doubles hitters. We don't want to have the strikeouts. And so, in a really positively performing market, we may not be the best performance firm. In a really down performing market, we're focusing on risk, but we're not going to go to cash, right? So we're not going to be the best performer in a down market, but over the long run, we're consistently have been pretty solid within our categories, and we can have consistent, repeatable results. We also believe within the fixed income side that's like the foundation of their portfolio house. We want to own safer, more secure fixed income bonds so that they can help reduce risk within the overall portfolio. Some strategies, focused on high yield bonds, really try to get every ounce of return out of their fixed income. And the problem is that those types of bonds act like equity when things aren't going well. And so it's not necessarily reducing risk in a big way within a portfolio context. So smart but double is really important as we make active management decisions over time. And so as we focus on the IPS and the long-term asset allocation, fewer smarter decisions and smart but humble, the result of that is a consistent and repeatable investment experience across risk-based solutions. Our strategy and value added is easily understood and explained, and losing less in difficult times helps members maintain a long-term focus and improves outcomes. I'll touch on this a little bit more when we get to behavioral finance, but really all the things that we want to try to keep a long-term focus for our investors, and the best way to do that is to lose less in difficult times, and that means focus on managing risk within your portfolio strategy. So we have asset allocation models across the risk spectrum. So really conservative investors, we have an investment strategy for you. For really aggressive investors, we have a strategy for you. That is our goal, is to have a consistent experience across risk-based solutions for members that we manage money for. So that was setting investment philosophy and portfolio strategy. Next, we're going to go into maintaining investment efficiency. So within maintaining investment efficiency, what we believe is reducing costs and taxes matter to portfolio returns and outcomes. The investment solution strategy should be scalable. And again, as always, our members' best interest is at the heart of everything that we do. So how we behave. We behave by utilizing ETFs, exchange traded funds, as the building blocks for our portfolios. We use ETFs today. That doesn't mean we'll always use them in the future. If we find a better vehicle that is lower cost with greater tax efficiency, we're going to look at it. Right now, ETFs are the best investment vehicle for our members in their best interest, and have been, well, since we were managing these strategies back in 2004. We were one of the first trust companies across the country to use ETFs exclusively within our portfolio strategies. Now, we're also non-proprietary. So what that means is we don't have our own ETFs or our own mutual funds that we have to use. So we can go out into the investment landscape and universe and select the right vehicle that's in the best interest of our members. Also, the scalability of the strategy really matters when it comes to reducing these costs. So what ETFs allow us to do is really focus on that asset allocation decision and asset classes. As we mentioned, that's the biggest determinant of risk and returns within a portfolio. It's not analyzing every individual stock in the S&P 500 or in the global markets and coming up with a decision whether you think it's undervalued or overvalued. It is really research costs are really high for firms that utilize those types of strategies. And usually what happens is those additional costs outweigh any potential benefits they have from being stock pickers. So really this strategy, ETF strategy, allows us to reduce research costs, transaction costs, and management costs. And those reduced costs end up allowing our investors to keep more of their returns. Also, ETFs have enhanced liquidity. So in times of crisis in the market, ETFs actually have been trading more frequently than the underlying stocks or bonds. And so, during times of stress like March of 2020, we were able to actively manage portfolios more efficiently using exchange traded funds. It also helps minimize company specific risks. So think back to when Silicon Valley Bank failed and we kind of had the quote unquote banking crisis. Our investors had no direct exposure to those holdings. Through the ETFs, the exposure to Silicon Valley Bank, Signature Bank in New York, First Republic, and there were about 5 others that Moody had on watch list was 0.06%. And so utilizing ETFs really helps minimize company-specific risks. You don't have to worry about one company going out of business and having an outsized impact on your overall portfolio returns. We're able to offer risk-based models across solutions across different risk tolerances of investors, and include responsible customization, including working through original securities, diversification plans if it's a highly concentrated and low cost, so lots of capital gains securities. And we can do strategies like tax loss harvesting that help reduce those costs like taxes in the long run. So scalability of the strategy is really important when it comes to the impacts on individual investors. And so the results of this is reduce costs and taxes, allow members to keep more of their returns. Again, what we're doing, everything we do is in the members' best interest. We want you to keep more of your returns. We have to keep the lights on. We have to maintain this investment strategy and the technology to do it, but we want you to keep more of your return. That's our commitment as being owned by credit unions. And we also have investment strategies for all investors based on and customized to their personal circumstances and financial goals. So that's maintaining investment efficiency. The third of the topics is addressing behavioral finance. So what we believe, giving into fear and greed, which we call the emotional roller coaster over a market cycle, can lead to poor outcomes. Investing is a roller coaster. Well, at the end of 2021, when growth stocks were up 30+% and the Federal Reserve was at 0 interest rates and everything looked great, we had lots of investors that said, geez, maybe I should take more risk. If I take more risk, I'm gonna see better returns in the long run. And while that's true, the problem is usually those really great periods when we're all feeling great about ourselves and markets are rolling, that's usually when the greed kicks in, and eventually there's going to be a downturn. And if those investors when we spent a lot of time to avoid this, but if those investors got more aggressive at the end of 2021, thinking things were going to be great forever, they had bigger declines in 2022 as the markets struggled. And so we really want to address this aspect of behavioral finance and manage that emotional roller coaster, try to keep consistency over the long run. One of the premises of modern portfolio theory is that all investors are rational. And I can tell you, not just investors, but individuals, we're not all rational. We all have bias, and we all make decisions that aren't just based on facts and data. And just even getting facts and data is increasingly difficult in the environment that we're living in. And so recognizing that not investors are rational and trying to address that on an individual basis can improve outcomes and results. We also believe in transparent and ethical presentation of investment performance. And again, our members' best interest is at the heart of everything that we do. So how do we behave to address the behavioral finance and the emotional roller coaster that investing can be? First is we are big believers in dollar cost averaging. So what dollar cost averaging, or DCA, is really a way to manage fear at the start of the investment process. And it's market driven rather than calendar based. So let's say a new investor comes in and let's say they had a CD that matured, or they had just money in saving account that they want to get invested. Well, rather than thinking that this moment in time is the low point for the markets over the next 6 or 12 months, we want to just be more conservative in how we start the investment process. So, and this is all customizable, but generally what we'll do is we'll invest half of the funds initially, and then over, it could be 3 weeks or it could be 9 months, we'll invest the rest. That way, if the markets sell off 5 or 10% in the short run, it's not that bad of a thing. Actually, in the long run, it's good because we can now use some of the cash that we still have to buy it at the lower prices when things are on sale. And we do this based on what's happening in the market rather than just calendar based. So some firms, they'll say, okay, let's invest 1/12 of the total investment over the next 12 months. What we prefer to do is watch what's happening in the markets. If the market is down 5 or 10% from where we initially bought, we're going to be pretty quick to get the rest of the equity invested. On the fixed income side, if interest rates go up, we're going to go in and buy more in fixed income. And so again, this DCA, dollar cost averaging, is just a more conservative way to start the investment process. And if you can start the investment process by being more comfortable, then that should improve long-term results as well. The other thing we believe in is what we call opportunistic rebalancing. And again, and I'll show a chart of this, but this really is trying to manage risks over the long term. We're trying to smooth volatility, smooth the ups and downs of that emotional roller coaster on an ongoing basis through the investment strategy. And we're really trying to change investor psychology. The whole goal to investing is buy low and sell high. But believe me, from a mental perspective, it is much easier to sell a security when it's going down and to buy it when it's moving higher. That's the opposite of what we want to do, though. And so we spend a lot of time with individuals trying to kind of change their mindset and really get into that buy low, sell high kind of psychology. And again, this opportunistic rebalancing is market driven rather than calendar based. And so this is what that looks like. These are the big decisions of where we decided to buy equities to our target across strategies, or to sell equities to underweight, or even in some cases overweight equities because we felt like there were some real opportunities. The point of this is, as markets are moving higher, we are really starting to think about managing risk, because we know markets don't go higher forever. And so the higher that stock prices and asset class prices go, the more we start thinking about, well, do we need to start managing that risk? And so you can see, for instance, the very left of this chart is March of 2020. During the big downturn, we were buying equities. When markets are down 20-25%, similar on the right-hand side in September of last year, the market was down 25% from the highs. That's usually when you want to be a buyer in the markets. And so we did. In end of March or end of September, we went overweight equities, and then the market rallied back. But you can see the pattern here. The idea is buy when the markets are lower or have moved down, and be a seller, manage risk as markets are moving higher. And really, that's our philosophy over the long run, and how we manage that mix between stocks and bonds, which again is the biggest determinant of risk and ultimately returns in a portfolio. The other thing that we really believe in addressing behavioral finance is having direct access to the investment team, myself, the rest of our senior investment team, and the decision makers for the individual investors. That's one of the things that I appreciate the most at Members Trust Company is I get to talk with the individuals that I'm managing money for. It makes me a better investor. It helps me to understand their psychology and to help them through the really difficult times in the market, like March of 2020 and last year. The more conversations we have, the more direct access, the more they can hear and listen to how we're managing risks and what we're thinking about markets. I think the better success that we have in keeping them sticking to their long-term investment strategy. And so when we're addressing behavioral finance, the outcomes we achieve is success for us is defined as making our members feel comfortable. We want them to stay on the roller coaster. There will be some ups and downs, but you got to stay on the roller coaster. It's time in the market, not timing the market. That's important. We want our strategy and value added to be easily understood. We need to be able to communicate things that we're doing within the portfolio where you can understand it. We want to have better understanding of our members' needs. We're not just managing 7 models. We're managing over 5,000 individual accounts for individuals, and that's a really important distinction. We claim compliance with the Global Investment Performance Standards, GIPS. So the investment performance that we are presenting is our actual client performance, and we are committed to transparency and full representation and disclosure. This is something that separates us as a trust company from a lot of other investment firms out there, is they have investment strategies, but they don't do this composite reporting to see what their actual clients. They can show what an individual security performance was, but not what the combination of all these decisions that investors make and the impact that it has. And so, we are committed to full transparency, whether that's costs and fees and returns, and just how these things are calculated. And we think that again, will help our members feel more comfortable, which ultimately will lead to success. So thank you for kind of the initial conversation of our guiding principles, our investment strategy, and how we're helping members through the investment process. I want to thank you for your time, and please feel free to reach out to your BECU Trust Services team, myself at Members Trust Company. We're here to help you through the investment process, and thank you for your time.